Okay, welcome everybody. I want to thank you for taking some time out today to join us for our second half quarterly outlook. We call it Fundamentals Over Fear or Other, which I think we left out on that title there, but it's a different take on FOMO for those of you that have heard that acronym, the fear of missing out. And we picked this title, as you'll see, is that I think that it's important that given what we've gone through over the last quarter, there's a lot of headline and a lot of kind of fear that's been generated, particularly around the geopolitical front. And I think it's important to go back to looking at the fundamentals, the data, and the things that really matter and what drives markets, and more importantly, portfolio returns. So, Jason, do you mind taking us to the disclaimer? Let's just go back for a second. So yeah. We'll give a few moments for those speed readers to go through it. We'll give you guys copies of all of this. But again, this is just a general disclaimer we always have to put out. Okay, next slide. Key points that we're going to talk about today is, look, despite everything that we might have been hearing, reading about on the geopolitical front, particularly around tariffs, the U.S. economy is resilient and it's been holding up well. Most importantly, the labor market is looking good. You know, Jason, I think the recent print was around just over 4%. And then second quarter GDP, we don't see the number yet, but again, it's expected to be in the positive, running kind of between 2 and 3%. I think the important thing and ultimately what drives stock prices is earnings. And, you know, the pre and post Liberation Day earnings, both what we've seen and what we are seeing for outlook, bodes well for the market. Because again, at the end of the day, putting all sentiment and headlines aside, if corporate earnings are good, then that means stock prices should follow. It'd be good as well. And then just in terms of positioning, you know, what we've seen coming out of this, that sell-off in April, a little bit maybe in May was, you know, we've seen technology and specifically the whole AI themed space lead this rally that we've now seen markets go to new all-time highs, which again, if you were to step back a few months, I think a lot of people would be not thinking that was even possible, yet this is what's happened. I think despite all, you know, the bullishness out there and the fact that we are seeing at new highs in the marketplace and the Canadian portfolios for that matter, I think that, you know, it's important to recognize that inevitably there will be other surprises in market volatility, but none of this is unusual. And we will point some things that we mentioned at the beginning of the year around volatility and just what is a normal year for it. So, okay, next slide here. Jason, help me again with this spider, why I shouldn't be afraid of it.
Spiders are very docile and they only attack when they're provoked. They're actually pretty good pets. I don't have one, but this is what I read.
But this one you said didn't bite or anything like that, right?
Well, it does bite if you if you decide to provoke it, it will bite you.
Anyways, I would still be scared of this thing regardless, but I think it at least lets us know that, listen, we're all human beings. And if we go to the next slide, it's a point that we're trying to make here. Listen, we all get a certain amount of anxiety. There's always going to be some geopolitical uncertainty. And there's always the initial gut instinct is, oh, geez, you know, tariff war happening, war in the Middle East, market's going to, you know, implode, right? And that doesn't always happen, or it doesn't happen in the longer period of time. And if we jump to the next slide here. So like we said at the beginning, the fundamentals for the market we're in right now remain intact despite the headlines we're seeing. And it's a thing that I like to kind of point out, and maybe it kind of codifies this a little bit, is that, look, even myself and Jason feel fear and greed. You know, we feel anxiety and those sorts of things. We also suffer, all of us do, from these type of behavioral biases. As human beings, we're all hard programmed to feel these things and have these things affect our decision making. And so that's why it's the best way to put it is you need to acknowledge them, but just realize you can't eliminate them. And by acknowledging them is that, you know, is that it reminds yourself that, you know, some of these, you know, like the confirmation bias, right? you see some negative news out there, and you're looking for something to confirm your belief that markets are going to plunge. I think those are the times you got to step back and again look at the data. Snake bite bias, which is another interesting one. It's one of these things where just because you had a bad experience in 2008, not necessarily with us, but you may have had one. It doesn't mean that just because the market sells off, you're going to have it again. And it's also a bias where sometimes we put a lot more weight on events that we've been affected by personally, and it affects us emotionally more than we should. Because at the end of the day, the market is without emotion and doesn't really care about yours and ours biases. It's driven by fundamentals, which is kind of what the whole basis of this presentation is. But I think it's important though that we all need to kind of acknowledge that we're going to have fear at time and greed at time. It's what we do with it that matters. It's not trying to pretend like we're devoid of all emotion, right? Even ourselves as portfolio managers. All right. Okay. Jason,
Yeah.
I guess am I this slide? Okay, yes.
No, I got this one.
Okay, you got this one. Okay.
Yeah, so just building on what Seth's saying, so like the market is really driven by fundamentals, and yes, sentiment can cause variations or volatility in the market, and we did see that. We've seen that quite a bit this year. As we've said in our outlook piece in January, we did expect this year to be a more normal year, and a normal year is volatility or downside in intra-year of about 15% in the equity markets. So we clearly got that this year. I think that might surprise a lot of people that we're having a normal year given all the headline risks. But if you look at the fundamentals, we have 9% earnings growth in 2025 and about 14% earnings growth in 2026. A lot of the risks, known risks, are priced into the market now. So that makes the investors more confident in the 2026 estimate. And as you'll see, there's a number of macro tailwinds that will support earnings in 2026. And if you kind of look at like the breakdown of S&P earnings for 2025, you can see the pillar of earnings growth is coming from technology and financials. So we got about 9% earnings growth for the year. And this is why tech is so important for the market. It really is providing the biggest uplift to overall earnings in the S&P 500. We still think we're in the early phases of the AI trend. So there's still plenty of upside, not only upside to the stocks, but also upside to earnings and earnings estimates. So some of the bigger macro drivers for the equity market, big beautiful bill was passed recently. There's a lot of front-loaded stimulus in the recent legislation. You can see in 2025, we've got about a 0.2% lift to GDP, but really the big lift comes in 2026, right ahead of midterm elections. So, the fact that we have this much stimulus entering the US economy really diminishes the chances that there'll be a US recession in the near future. We also have the Federal Reserve, who's looking to cut interest rates later this year, so more stimulus to the US economy. This is basically the dot plot, which is basically taking all the Federal Reserve's projections for where they think the interest rates will be. And based on that, they're projected to cut about 50 basis points in 2025. And again, I don't think it's necessarily, we'll get the cuts. We may get one cut. If we don't get a cut, that's fine. I think it's that the Fed is directionally willing to say that they're going to cut, and that's keeping the market happy. We could see, the Doge government cuts were just passed by the Senate. It might get passed by the House. We could see an uplift in government unemployment. That could lift the unemployment rate in the US and then prompt the Fed to actually cutting rates later this year. So that, we could see a little bit of a upset in the labor market, which would actually probably be a positive for the market because then the Fed will start cutting interest rates.
One thing interesting on government cuts you talked about, and obviously you got lots of headline stuff with previously with Elon Musk. I mean, quietly, our new leader here in Canada, Mark Carney, the Prime Minister, has announced 7 to 10% cuts across the board on everything,
Yeah.
crown corporations. And it's interesting how the media covers two different events, but both are pretty, material with cutting of government spending.
Yeah. And then on the labor market, U.S. economy has been adding about 130,000 jobs per month year to date. Those are pretty solid numbers. But if you look at this blue line is this labor sentiment indicator, you can see there's a pretty big divergence. That's understandable given the policy uncertainty around tariffs. But we have seen in recent months a nice little uptick in that soft sentiment number. But nonetheless, U.S. economy, employment-wise, still doing pretty strong. So people have jobs, people are going to continue to spend. The retail sales numbers that were out today were pretty robust. And so,
And just a reminder that, the U.S. consumer drives 2/3 of the U.S. economy. And so if the U.S. consumer is still spending and they're still in okay shape, that means that you're going to see positive growth and ultimately, translate into companies' earnings being decent. All right, another kind of perception versus reality. So I mean, we get this one, and it does come up naturally. It's interesting that when markets are starting to hit new all-time highs, people that might have money on the sidelines, or even have money in the market, maybe like, do I pull my money out now? Is it going to fall? Is there going to be a big sell-off, or is this still a good time to invest? And the upcoming charts, I think, are going to show very clearly that. I think it's good to ask the question, but I think, outside of the context of your own personal need for funds, I think data and history is pretty conclusive as to answering that question. One other thing I'll just say before we get to this is that, it's also a reminder, you think back to April and May, and if you turn on any of the news stations or like that, and just the amount of just diarrhea come out of people's mouths, to put it bluntly, talking about all the bad things that may happen. And the reality is markets went to new all-time highs. Remember, those people aren't accountable to any of us, and they're not necessarily talking about realities, they're talking about perceptions. So, Jason, take us to the data, tell us why.
yeah, so clearly people have strong emotions about what's happening in the States, what's happening in Canada, yet we have markets sitting at all-time highs, which I think, probably is shocking to a lot of people. We built this chart starting on the 19th of January, 2024. And the reason we did that is because that's the last time the market hit an all-time high. So we've gone over a year with the market making successive new all-time highs. And we did obviously have a bump in the road in April, but when you're in a bull market like we are today, this is what happens with new highs. It's a confirmation that something's going right in the economy, or something's going right in corporate earnings. It's a confirmation.
And it's an example of reality versus perception, right?
Yeah. So you may be wondering how Cadence is doing. It's showing since inception, since we launched the pool in April of 2023. We also achieved a new all-time high just recently, and up about 40% since we launched
41 as of Tuesday.
41 as of,
Yeah.
There we go.
Yeah. Well, the market's been
And
down a little bit today it was up, but things were down a little bit yesterday. So,
and just for comparison, we've got the TSX there. So, we're doing a good job, doing what you guys have hired us to do, which is to generate positive returns and try and beat the market. And we're happy to say that we've been doing that.
yeah, and I think the other thing too is actually just go back there for one quick second. Is you also notice that our drawdowns weren't as great as what the market was, right? Or our benchmark in this case. And of course you've seen since April, comparing the TSX to ourselves, which is our benchmark, we've handily not only outperformed it, but I think 40%, over 40% in a couple of years isn't too shabby.
You guys may remember this slide because I think we've shown it more than once, but we're going to show it
Done a few
again.
times.
Yeah. So the last time we showed this slide was July 2024. It basically outlines what happens when you invest your money at all-time highs. So if you invest at all-time highs, 1 month later, you're 1.5% higher. If you invest all other days, 2% higher. If you look 24 months out, investing at an all-time high versus any other day, it's pretty much the same thing, if not a little bit better. I think that surprises a lot of people that putting new money to work at new highs actually outperforms all other days. Sure, you'd love to pick a bottom. That's one of the hardest things to do in this job is to pick bottoms. But the fact that markets are making new highs, strength begets strength. It's confirmation that things are going right. So this kind of plots where we are in historical, relative to historical bull markets. As you can see, bull markets are elongated and extremely powerful in terms of their upside potential. You can see we're clearly still in the early innings, assuming that we have a average bull market, and bull markets typically last like 5, 6 or longer years or longer. Just talking about the positioning. So this chart shows you investor positioning within equities. If the line's up around here, it means investors are all in and they're overweight equities. If they're on here, they're underweight equities. You can see we're slightly below the average, meaning that not everybody is all in equities. We don't have that irrational exuberance. So there's still money that can move into the market and push things higher. And money has been coming into the market.
I love this one.
Why don't you take this one, Seth, seeing as you like it so much?
Yeah, I guess so. I mean, it's interesting. I just sent you something that came out today, some data, how Canadians, and it's still in record numbers in the last 4 months, have been selling Canadian securities and buying US. This is just looking at money coming into US markets. And again, this is where, reality overrides perception. Again, maybe a little bit different now that we're hitting all-time highs, but if we took a step back a month or two and asked people, do you think there's net money coming out of the market or going into the market? I think a lot of people, they just had looked at the headlines and things like that, would have thought, well, people are rushing for the doors, they're selling out of the US markets. And it's actually been something to the contrary. And not only to the contrary, it's actually one of the strongest years for inflows into equity markets that we've seen definitely over the last decade. I don't know how far back this data ultimately goes, but again, this is a reality versus perception check. The data tells us that there's a lot of new investors coming in, not leaving the market.
Yeah. And they're possibly trying to get ahead of July, which has been one of the best months of the year. In the last 10 years, we've seen positive returns for July. Let's go for 11. It's interesting, the sell in May and go away. That heuristic is kind of out the door. And the Santa Claus rally, which typically starts in December, goes into January, and the January effect, those other heuristics, we don't really, in the last 10 years, it's interesting to see a bit of a reversal. So
yeah, I mean, I think about when I started the business now, Jesus, being on 27 years ago, I remember some of the older advisors telling me, get ready for the Santa Claus rally. The sell in May, go away. And it's interesting to see how over time it's changed. But I kind of commented to you, Jason, that this also kind of reminds me of anybody that's played roulette when you see the red black and you think, okay, I'm going to spend 5 blacks in a row and put it all on red. It has to be red. The reality is, I think what this also tells us, I mean, as much as July recently looks good, don't simply rely on some heuristic rule of thumb to drive your investment decisions in the short run.
Um, Investors love to make money, Seth, but they don't want to take any risk. Can you
Of course not.
achieve equity-like returns without any downside?
Uh, well, depending on who you talk to, some people are going to tell you, there's no risk investments. You can invest in these certain types of investments and get GIC type returns. I say this with a big smile because I roll my eyes. Sometimes when I see advertising, when they're trying to convince investors to invest in something and they're really downplaying what the risks are. The reality is to make money, you got to take risk. And if you're making money and thinking you're taking no risk, then you maybe should take a circle back to what you're actually invested in, because it could very well be something that may not end well for you as an investor. Um, this little chart here, just to kind of to show you, is looking at, and this goes back to what, Jason, I think 1926, yeah.
Yeah.
So, I mean, there's longer periods of time, and these numbers fluctuate a little bit, but it pretty much tells you that stocks are the best place to be an investor in. But it also tells you it's also the riskiest, right? That's historic standard deviation. So that means, how much typically the market within a certain standard deviation can go up or down. Obviously, our goal, what we do at Cadence is to have a lower standard deviation while still making a return. I think, bonds, as boring as they are, they're not risk-free. And it's important to understand that, yes, bonds are safer than stocks by quite a bit, particularly over longer periods of time. But it's important to understand that they're not a risk-free investment, right? Treasuries, one would consider them risk-free. I think it's debatable if you start to look at things like inflation risk and things like that. So far, knock on wood, never in the history of the United States or Canada have they defaulted on their treasuries. So, I guess if there is anything that's as kind of risk-free as possible, it's probably treasuries. But again, inflation's an issue. One of the ones that they don't have the returns on this, and I just want to red flag it because I'm hearing a lot more of it recently, is private and alternative investments. And let me be clear about something. It's not that there's anything wrong with investing in private real estate or mortgage investment corps or private equity. That in itself is a valid asset class. But I think that given the amount of things that Jason, you and I have seen with some new clients that have come into us that have been in this kind of stuff, you got to be really careful about how they're pricing their net asset values. And I would argue that, and I won't say the names of the firms, but there's some firms that were bragging about making money in fixed income in 2022 when everything that was public was negative, yet they said they made 10%. And it was private fixed income. And it's up to them to set the prices. I'm not saying they did anything wrong, but just being somebody who understands risk reward and how to make money and risks and things, thinking about those things, I'd be a little bit suspect of that statement. And so again, we don't do it here at Cadence, any really private equity stuff. But it's just stuff to be aware of, because inevitably, when things are probably getting worse for that area or that sector, is when you're going to see more marketing and things like that to try to entice investors in, right? So buyer beware. Is that mine or yours? Oh, that's mine. Okay. Well, it's easy because we talked about this slide in January 2025. And like Jason talked about earlier, and I mentioned at the beginning, this is a typical year for volatility. So typically the S&P drops about 14-15% in any given year. We're basically right on track for that. Last year was unusual because there just wasn't much volatility period. But again, as you can see, bull markets, bear markets do have these pullbacks, right? And you just have to realize that's part of the investing side of things. Doesn't mean that the bull market's over, as we believe in this case. It just means that volatility is normal. In this case, it came from south of the border with the new leadership down there. Okay. I guess this is my slide. Perception again. Yeah, this is one had Jason and I scratching our heads a bit. Given what happened in the Middle East, given the state of the Canadian economy, given I think some issues we have around productivity in this country and just lack of ability to develop infrastructure. I would think that the Canadian dollar should be lower and oil should be higher and Canadian bond yields should be higher, but we've seen the opposite right across the board.
Yeah.
And Jason, do you want to jump into kind of talking what this chart exactly means here?
Yeah. So this is a long-term chart of the Canadian dollar. You can see it's traded in a pretty consistent range over the last decade or so. 68 cents and 82 seems to be the upper and lower range. I recall earlier this year we had some clients asking about should we be selling Canadian dollars? This was after, this big massive move in the Canadian dollar. And we just kind of pointed out the fact that, well, it found support here two times in the last decade. And lo and behold, Canadian dollar, for whatever reason, found support at 68 cents again. This is probably one of the biggest challenges that Seth and I face in terms of the portfolios. We have an allocation to the US, one of the deepest, most dynamic markets in the world. But the fact that we're Canadian investors and you're Canadian investors, there's a currency drag. Canadian dollar's up about 5-6% year to date. That's obviously been detracting off the US dollar returns. There's really no good way to hedge currency. And you also have to be right if you're gonna hedge, and you could be wrong, and you end up spending money on a hedge that doesn't really work. So
And I think the reality is over the long run, it doesn't really matter if you're picking good companies. I mean, our fixed income side is for the most part hedged. But our equity side, again, the kind of return profile we're looking for does take into account, potential currency moves. And, with where it's sitting right now, as a technician, Jason, would you say that, is Canadian dollar going to go higher here or is it going to go lower? I'm asking for a prediction here.
yeah, so we think it's a little more, the risk reward's balanced here. I would say, I would think that the Canadian dollar likely will drift back towards the 68, just given that in US dollar terms, the US dollar is extremely oversold. Uh, if we're wrong here, I think the Canadian dollar could get up to 76. So you've got about 3% more upside in the Canadian dollar, and probably, we drift back down towards 70. So three cents on either side. I would favor 3 cents Canadian dollar giving back a bit.
So basically what you're really saying is it might be a little bit cloudy or it might be a little bit sunny.
Yeah. It's a funny thing. You'd think the Canadian dollar would be weaker, but maybe the Canadian dollar's rallied given the election and what Carney's doing, and the fact that we might actually build some pipelines and get this country turned around. So, yeah, definitely a little more bullish on the Canadian dollar and Canadian economy after the election. Um, on interest rates, there was a lot of talk that the US 10-year yield would go to 5% when the big beautiful bill was being batted around Congress. Um, we just seen the 10-year kind of just slip the whole time that the big beautiful bill has been debated in Congress. Really, yields haven't moved anywhere. So again, it's this concerns that never really materialized. And you can worry about these things. Obviously, it's something that's in the back of our mind. If we start to see yields pop up above the recent high here, we would get concerned about it moving to 5, and that would have an impact on equity prices. But again, it's expecting something and getting the opposite result. And then on oil, these one-time spikes in oil, they don't really translate into long-term appreciation for energy prices. Seen it time and time again. You'd think this drop in oil right here was after Iran actually fired those missiles at the Kuwait, Qatar base and the U.S. base. So, logic would say, oh boy, oil should be going up, but it didn't. It actually sold off. So looking at the fundamentals of oil and demand is pretty well balanced, and so I think we're pretty much range bound for oil prices. Uh, okay, this one's for me, Seth. Canadian economy is kind of weak. Why is TSX at all-time highs?
Good question, Jason. Yeah, I mean, listen, we've talked about this before. I mean, we've been of the belief that Canadian economy has, trotted along, slightly above, positive for the last decade. And part of it is, we've done a lot of harm to Canadian productivity, and there's been a few different reasons for that. But talking about biases, again, I think, maybe Jason, you and I maybe had a little bit of this bias that we didn't acknowledge, is, that recency bias, right? Just because the Canadian economy and the market might have lagged or, didn't keep up as much as we saw south of the border, doesn't mean that's always going to be that same going forward. And, it's funny I think it's actually in our disclaimer at the beginning, but every compliance person makes you say, past performance isn't indicative of future results. Well, basically saying is, history doesn't repeat itself in the same way that it did before. And, I think this is an example that we're seeing the TSX break out to new all-time highs, despite some of the issues that have been, well, in my opinion, are a little bit more systemic when it comes to lack of infrastructure build, lack of productivity, and things like that that we've witnessed over the last decade. From ashes to Phoenix will rise, heuristic. Yeah, I mean, this is another one too, right? Is with all this trade battle that's going on, there's this belief, this idea that, out of the ashes, again, the Phoenix will rise, that, despite everything that the Canadian economy is going to go through, that, suddenly with them cutting rates and things like that, the economy is going to take off. I mean, maybe it will, maybe it won't. I think obviously the data is going to tell us that. I think the bigger thing is to see what our new prime minister actually gets done. He's laid out a bunch of stuff, and I think we need to watch to see what happens action-wise, right? Bullion, yeah, that's another one. You look at part of what's been driving the TSX. It's been financials, it's been materials, things like gold, for example. You look at the gold side of it, and part, which is part of the materials, been the biggest driver of the TSX this year. All you have to do is look at gold price, and look at the gold stocks for that side of it. I think one of the surprising ones is consumer discretionary, which is a bit of a small sector here in Canada. But the fact that, that's the second best performer. And
Dollarama.
Yeah.
That's Dollarama.
Yeah.
That's the funny thing with the Canadian market. It's like there's probably one or two stocks in these sectors that are driving those returns.
Yeah, absolutely. And yeah. So, and then energy, which, by the way, going back to the previous slides of, it's something to point out, it's barely up this year in general. And again, you would thought of the things that were going on in the Middle East, that, energy would have been one of the best performers. That's what happened in 2022, if you recall, when Russia invaded Ukraine, when everybody said energy is not going to do anything because Ukraine doesn't, produce any oil, and we saw quite the opposite happen. So again, all right, next slide. Oh, are we at the bottom line? Do you
Yeah.
think? Okay.
I know. Yeah.
Maybe we will keep to the 35 minutes we told Laura we'd do.
Yeah, we're close. It's going to be a record, I think. So just to kind of summarize, there's macro tailwinds that support the market. We're expecting central bank rate cuts, which will provide liquidity to the market. We have more fiscal stimulus coming from the US, a bump in 2015 fiscal stimulus and a big one in 2026. Obviously, concerns around that have been around interest rates spiking. Market has, for now, been able to digest the fact that the US is adding debt and deficit to their national debt. but we'll have to, I think that's a long-term, obviously long-term issue that the investors will have to grapple with. Uh, geopolitical geopolitical tensions obviously will have impacts on the market, but they tend to be short-lived, and investors revert back to focusing on the fundamentals, where you have corporate earnings that are growing 9% this year, 14% next year, and we have a little bit less uncertainty in terms of the tariff risks. So the political uncertainty, the known risks are built into the market, and investors are a little more comfortable with companies' ability to meet those earnings estimates. Likely the biggest risk is inflation. We still don't know how tariffs are going to really feed through to consumer prices at a time where will be possibly seeing slower GDP growth, perhaps in the back half of this year. Hard to see slow GDP growth in 2026 given the fiscal stimulus, but stagflation is something we have to kind of keep in the back of our mind.
Yeah, I think that's, again, that's a data point, not a perception. It's a reality data point that we obviously keep a very close eye on.
Yeah,
So let's show some fun stuff for people that are invested in the pool.
yeah. So just final thoughts here. So pool is up 40% since inception.
41%, Jason.
Sorry, 41%. I'm one day behind you. So I think most investors like this chart, but the chart that we really focus on and really like is looking at the portfolios relative to the market in terms of downside capture. So these charts plot the blue is the select pool. The green line is the market, the S&P 500, TSX. The idea here is that you want to see more white space between these two area bars and the line. It basically is telling you that the pool has less volatility than the market. The more white you see, the better we do at protecting the downside. You can see since inception, we've done a pretty good job outperforming the market in terms of downside risks, both in the S&P 500 and the TSX. The big bounce back here on the TSX has really been around gold. The Canadian markets have outperformed the US year to date because of that materials trade. We do have some gold exposure. We just don't have as much as the TSX, and we're not willing to take on the same kind of risk that the TSX has. So, yeah, broadly speaking, we're pretty happy with how we've been managing the downside risk. And I think manage the downside risk,
the returns will follow.
The returns will follow right there.
All right. Well, we were a little bit over 35. All right. Any questions out there? And by the way, at the end of this, when you do sign off, you'll be asked to do a survey. Please, if you could give us a few thoughts, and it helps us try to, put these things together at a more efficient and communicative way. It's just a short survey. I think it's 4 questions. Eileen gave me a Post-it note to make sure I didn't forget to tell you everybody this time. Please ask some questions. It's anonymous. You can be anonymous. Nobody who's signed in is going to be able to see it. Or if you want us to see it, we can see it. But don't be shy. You can ask a question you want. I hope we didn't leave everybody speechless.
Well, I think we did.
All right. Well, listen, feel free to pop us an email as well, or just give us a call if you want to talk about something in the presentation or just something in general that we didn't touch on. Did we just end the whole presentation?
Nope.
Okay.
We didn't.
Anyways, you'll get a copy of the whole thing sent out to you along with the recording. And again, I just want to thank everybody for coming out. Again, if you got any questions or anything specific to your situation, just pop us an email. We're happy to hop on a call and give you more details. And again, thanks everybody. Appreciate taking the time today.
Thank you.